Hey, what's up, you guys? Swan here from Swan Things. And today, let's talk about insurance. Now, I've always been a bit of an insurance skeptic. I always thought it was kind of a waste of money because my company provided health insurance, the products were really confusing, and insurance agents are kind of scary. Nevertheless, I decided to do a deep dive into this topic, where I speak to insurance agents from the top insurance companies in Malaysia to fully understand my choices when it comes to getting insured. So, in this video, I'm gonna give you a complete guide to everything you need to know about insurance. What types of insurance are out there, how much coverage do you need, and what to look out for when shopping for insurance plans. So, without further ado, let's begin. So, to start things off, let's talk about how insurance works. Basically, people who buy insurance policies contribute a certain amount of money called a premium to a pool of funds managed by the insurance company. In return, these people are protected against risk outlined in their insurance policy. For example, if this is a medical insurance and this guy ends up being hospitalized for a stroke, the insurance company pays for his medical costs by taking money from this pool of funds. This is the reason why people with higher risks, such as smokers or older people, are required to pay a much higher premium to be insured, because they have a higher chance of making claims in the future. There are three basic types of insurance coverage: medical, life or total permanent disability, and critical illness coverage. Medical insurance, of course, pays for medical bills. Any illness or accidents that require hospitalization will be covered, with the exception of self inflicted injuries, pre existing conditions, dental work, and other elective surgeries. Life and Total Permanent Disability, or TPD, pays out a certain amount of money to you or your loved ones if you die or are hit with a permanent disability that takes away your ability to earn an income. And finally, critical illness cover also pays you a certain amount of money if you are diagnosed with a critical illness listed under your plan, to replace for any loss of income while you recover from these illnesses. Now, each of these insurance can be bought separately as standalone term plans or bundled together in a package that's often investment linked. But before we get into which option is better, you must first figure out how much coverage you need in the first place, because the goal here is to get just enough coverage at the lowest cost possible. So in the next section, let's help you figure out how much insurance coverage you need and what to look out for when you're shopping for insurance plans. Let's start with medical coverage, which is essential for everyone at every stage in life. Now, Malaysia has one of the highest medical inflations in the world, coming in at double digits for the past few years. And even though we have a pretty well established low cost government healthcare system, it can be really congested and not all medical costs are fully subsidized. So, in terms of financial planning, a large unexpected medical bill can completely derail your hard fought journey towards financial freedom. And even if you are financially free, a large medical bill can still wipe out a substantial portion of your net worth, and you may risk losing financial freedom over it, which is why medical insurance is so essential. Now, the two most important criteria when shopping for medical insurance will be annual and lifetime limits, which is the maximum amount you can claim in 1 year and in your lifetime. Now, typically, most medical insurance nowadays come with no lifetime limits. And so this is what we should aim for. In terms of annual limits, there isn't exactly a guide on how much you should be covered, but a general consensus would be between 500,000 ringgit to just over 1 million ringgit to pay for the most critical illnesses and for any medical inflation in the future. Room and board should not be a priority, but you do have to make sure that you have the option to top up or upgrade your hospital room without any restrictions or penalties. This way, you don't really have to pay too high of a premium cost and go for the basic 200 ringgit room and board, but still have the flexibility to upgrade your room if and when you need it. Other important things to look out for could be deductibles, which is the upfront payment that you have to pay before your insurance kicks in. You also have to look out for co-payments, or sharing of the treatment costs between you and the insurer. You should also look out for the reputation of the company, because that will impact how easily you can make claims in the future. It's a pretty long checklist, so I've compiled the most important points that you need to look out for in this table here. Next, we have life or total permanent disability, TPD. The function of this insurance is to give a cash payout to make sure that you or your dependents will have enough income to survive on in case you pass away or lose your ability to earn an income due to permanent disability. The conditions to get this payout is outlined very clearly in your insurance policy. You either die or you lose both eyesights, both limbs, one limb and an eye, or are not able to perform basic life functions or require constant care. Basically, worst case scenarios. Now, if you have dependents or people who rely on your income to survive, then life and TPD coverage is super important because you want to make sure that your loved ones are taken care of financially regardless of what happens to you. But if you're single and don't have any dependents, it might not be such a big priority. Although it might still be a good idea to consider it in case your life situation changes or you're hit with TPD. The thing about life and TPD is that you may not need this coverage throughout your life. Because if you're able to achieve financial freedom at a certain age, you are essentially insuring yourself with your investment portfolio. If you die or are hit with TPD, your investments will still be able to generate enough passive income to pay for the expenses of you and your loved ones. So you no longer need that cash payout, although it is a nice perk to have. As for how much you should be covered, a general rule is to have a minimum of 10 times your annual salary in coverage, although a better approach might be to base this off your expenses. Simply take all the necessary expenses for you and your dependents in a month, multiply that by 12 to annualize it, divide that by 5%, and then take out your current net worth from this number. This number should be the maximum amount of coverage you need, because this number combined with your current net worth when invested at a rate of return of at least 5% will generate enough passive income for you and your dependents to maintain your current lifestyle nearly forever. Take note that of course a higher coverage will mean you have to pay higher premiums, and so you should aim for a balance between high coverage and a low premium that fits comfortably within your budget. Another important point I would like to stress on is to have a discussion with your dependents on your life coverage and how to manage this cash payout, because this cash can run out really quickly if not invested. But if invested properly, this cash payout can potentially sustain your dependents for many more years even after you've passed on. So do have this conversation early on. Last but not least, we have critical illness coverage, which is also a cash payout to replace any loss of income if you are diagnosed with and need time to recover from any critical illnesses listed under your plan. Typically, this would include 36 or 42 critical illnesses, including heart attack, comas, cancers, strokes, and so on. Take note that any medical bills arising from these illnesses will actually be covered by your medical insurance. The critical illness coverage just gives you an additional cash payout to replace any loss of income from you if you need time to recover from these illnesses. The general guideline is to have at least 1 to 3 years of your annual income in critical illness coverage, because this amount of payout will allow you some peace of mind to take time off work to focus on your recovery. And it also provides you some buffer time for you to get back on your feet and back into employment. While it may not be a priority for everyone, if you do have a family history of critical illnesses, it is advisable for you to get it because you have a higher chance of needing it in the future. Thankfully though, critical illness coverage is generally pretty cheap as both a standalone plan or as an optional add-on in investment-linked plans. Again, because this is a cash payout type of insurance, you may not need this coverage throughout your life, because once you're able to achieve financial freedom, the cash payout is no longer necessary. Now that we've gone through how much insurance coverage you need, let's take a look at your options when shopping for insurance plans. As mentioned earlier, you can buy all 3 types of insurance as standalone term plans, or you can get all 3 bundled in one investment-linked plan, sometimes called whole life insurance. Both of these options come in both conventional and takaful plans, which operate based on Islamic principles. Anyone can go for takaful plans, but in terms of coverage and cost, there really isn't a big difference between the two. Term insurance provides coverage for a fixed period of time. There are 2 types of term coverage. First is a yearly renewable term, which covers you for 1 year and can be renewed at a higher premium every single year. Next, certain products come with a year level term option, which covers you for 5, 10, 15, or even 60 years at a fixed premium throughout the coverage period. The amount of premium for year level term is higher than year renewable term in the early stages. However, since the premium is fixed over the entire coverage period, the premiums become cheaper later in life. Take note that with term plans, your coverage will end as soon as your term expires. You can then choose to purchase a new term plan, which often comes with a higher premium. You do have to take note that if you have made a substantial claim in the past, there is a risk that the insurance company may choose not to renew your insurance, or they could impose a much higher premium if they do renew your coverage. The main advantage of term plans is in its low cost. The premiums are often much lower than investment linked plans for the same amount of coverage. This is partly due to the increasing premium structure and partly because most of the premiums you paid will go towards the cost of insurance, with a much smaller percentage paid out to insurance agents as commissions. This may be one of the reasons why insurance agents will nearly never offer term plans as an option. In fact, 3 out of 5 of the insurance agents I spoke to flat out told me that their company does not offer term insurance products, even though it's easily found on their website. So just do your research and be careful when you speak to insurance agents. I've had the good luck of speaking to 2 wonderful insurance agents, but there are also others out there who are either not fully aware of their company's products or they're just looking out for their own interests. Whole life insurance, on the other hand, is like a mix and match combo, where it combines all 3 types of insurance under one plan with optional add-ons or riders that can be added to your plan to increase your coverage in specific areas. These plans are often investment-linked plans. When you buy an investment-linked plans, the premiums you pay are divided into 3 portions. The first portion goes to pay towards your insurance costs. The second portion goes to pay agent commissions and miscellaneous costs, and the third portion is invested into a fund that builds up your cash value. Because you're putting in extra money into these 2 pots, the premiums payable under investment-linked plans are much higher. The function of this cash value is not to grow your wealth over time, but to pay for any rise in insurance costs thanks to medical inflation. This is one of the reasons why investment-linked plans are able to maintain a relatively stable premium payment over a long period of time. The cash value can be redeemed in 3 ways. First, at the end of your insurance policy, you can receive all the cash value as a surrender value. Second, this cash value can also be used to extend your premium coverage if you are unable to pay the premiums for a certain period of time. Third, you can also borrow against this cash value if you are tight on cash. The cash value, however, is not guaranteed and will depend on the performance of the investment fund that you have selected. So you do have to take note of these funds. If the investment does well and medical costs don't go up significantly, the cash value builds up. However, if the investment does badly or insurance costs increase significantly, this cash value may even go to zero, which means that you don't have anything to redeem from your cash value and you may even be required to pay higher premiums because the cash value can no longer cover the insurance cost. So don't think of this cash value as an investment meant to grow your wealth. Think of it instead as sunk cost that goes towards paying your insurance premium. While the disadvantages of investment-linked policies is in its high cost, the advantage is that you may be able to redeem a cash value at the end of the policy period. The premiums you pay also stay relatively stable over time. Moreover, it is a comprehensive all-in-one plan that takes care of all your insurance needs until an old age. So you don't have to worry about your coverage ending as long as you keep paying your premiums. After doing a thorough comparison, investment-linked plans turn out to be the most cost-effective solutions if you plan to maintain your insurance coverage for more than 30 years, especially considering that you can get some cash value out of the policy at the end of the policy term. However, just take note that this cash value is not guaranteed, so the math can be a bit fuzzy. Take note that life, TPD, and critical illness coverage may not be as important later on in life, and so you might be able to consider it as a separate standalone plan to save on costs. However, medical insurance is important throughout your life, So you might want to consider an investment-linked plan that focuses just on a basic medical coverage. After checking out and comparing plans from the top insurance companies in Malaysia, I do have to say that AIA comes out on top with the most comprehensive coverage at a competitive cost, for my personal situation at least. A close second would be Prudential, which also gave a comprehensive coverage at a relatively low cost. Obviously, your needs will be different from mine, but if you're unsure of where to start, consider AIA and Prudential as your first places to look. Also, take note that insurance premiums are tax deductible up to 6,000 ringgit a year, so do declare it in your tax filings. And that's all I have for you today. Now, insurance products can be really confusing and complex, but I really hope this summary can help you better understand your options when it comes to buying your first insurance plan. Obviously, there are far more details I wish I could have covered, but I cherry-picked the most essential points for the sake of simplicity. As always, I am not an insurance professional, so do reach out to insurance agents and grill them on the specific details. Just be careful when you talk to them because some of them may not have your best interests at heart. Don't be afraid to shop around because you'll likely be committing to a lifelong insurance plan. As always, smash that like button and subscribe to my channel if you haven't already, and hopefully I'll see you in the next video. Bye!